Some personal finance questions answered. Our expert today is Hemant Rustagi of Wiseinvest Advisors. He joins us. Hemant, despite a marked improvement in the way investors plan their investments, many of them still don't pay attention to risk management. How should an investor think of risk management?
Well, risk management should ideally be the focal point of, any investor's financial plan. But unfortunately, there are a number of investors who do not really focus on this very important aspect of their investment process. Usually, investors have to manage two types of risk. One risk is to the investment that they make, and the second is the risk of any financial distress to the family member in case of an unfortunate event of a death or a disability. As far as the investment risk are concerned, there are broadly four types of risk that investors need to manage. First is there is a performance risk. As we know that every investor portfolio has a mix of securities, and they tend to behave differently over different time periods. And this obviously over a period of time, have an impact on the portfolio return. So to minimize the impact of these non-performing securities on the portfolio, I think it's very important for every investor to have a diversified portfolio. So diversification is the key here. The second risk is obviously the volatility risk. We know there are asset classes like equity and to an extent even gold, which have the potential to do very well over the longer period. But for investors to benefit from the long-term potential of these asset classes, they have to manage the risk of volatility in the medium and short term, which can be done by systematic investment. So a disciplined investor can benefit over the long term. The third risk is risk of inflation. This perhaps is the biggest risk for any long-term investor. Therefore, the asset allocation has to be such that it should be able to beat inflation over a period of time. And I think it's equally important to invest in those instruments which have the potential to provide tax-efficient return. Okay. I think so that investors can earn a positive real rate of return on a consistent basis. Okay. And this is where I think options like mutual funds score over others.
Hemant, I think we have run your four classes of risks. They're running out of time, so let's get a guest in. Pravesh Katoch from Gurgaon has a question for you. Pravesh, go ahead. What is your question?
Hello, can you tell me more about term insurance? And I am earning 25,000 and I can invest over 3,000 per month. And which is best for me? You can suggest.
Hemant?
Yeah, term plan is basically a pure risk cover kind of plan. It's very different from usual traditional plan like money back or endowment, where at the end of the period you get some money. And this is a pure risk. The advantage here, which means that even if you survive the term, you will not get anything back. But if in case something were to happen to you during this term, then the beneficiaries will get the amount of risk covered. The major benefit here is that these plans are much cheaper in terms of premium that you pay, and you can get much bigger risk cover as compared to the traditional plan. So yes, you're doing the right thing by going for a term plan, which is ideal product, as I mentioned earlier. For your kind of income, I think if I apply the thumb rule, you will require a term plan for around 30 lakhs. At your age, I think it should cost you somewhere around 5,000, 5,500 per year. Some of the term plan that you can consider here is ICICI's iCare or HDFC's Click to Protect. I think these are two policies you can check and then go ahead with this.
All right. All right. Thanks so much for joining in. So that's the view coming in on the personal finance segment.